Well, good morning, John. Good to see you. You're in Melbourne. I'm in Sydney. You've been giving presentations around the place in Perth and so on. John, the market's within 2% of its all-time high. It's on a pretty demanding multiple of 18.5 times. That's about 30% above the long-term average of 14.5. And we don't have much earnings growth. In the meantime, CPI numbers came out the other day, slightly weaker than expected. Do you still expect interest rate cuts, and is the market still on an even keel as far as you're concerned?
Yeah, look, I think the interest rate cuts are still in play. I keep on saying that the central bank is very concerned about reducing mortgage stress. So the highly indebted 30% of households who have mortgages, and as we said after the election result, the current government wants to push more debt into that sector with its housing policies. So I think the next cut's pretty well assured. There's probably another one. The issue of inflation is there's competing forces at play. You know, we've got the petrol price down because of the American policies, producing energy, producing oil and gas, pump, baby pump, that sort of stuff. But then we've got the electricity issue, and this week it was in New South Wales, I think the East Coast. You know, we're predicting wholesale prices of electricity up 10% next year. Now, an appalling situation. So, you know, that really crucifies the household sector. And when those government support mechanisms drop off by Christmas, we're looking at very steep increases in electricity, which is going to put a spanner into the CPI next year. But I think this year the RBA is just going to close its eyes to that and not think about it too much.
Yes, so I just read this morning that without those subsidies, the electricity price would have been up something like 17% year on year.
Yeah.
Another interesting development in the energy sector is the government's approval of Woodside's Northwest Shelf expansion. You know, the gas program there now permitted to run till 2070. So this looks like a very big turnaround. Obviously, the government was holding off that decision until after the election. The market responded by marking up Woodside's share price 4%. Surely this is good news?
Well, what a difference an election makes, Paul. You know, like this is things being reviewed for years, and here we are 2 or 3 weeks after an election, and all of a sudden the new minister can make a decision and commit a project to a 40-year development where we struggle with developing a nuclear industry, but that's a side issue. I mean, you'd think Australia was full of long-term planning. It's full of long-term hurdles, and the timing is appalling because, you know, the government, the Parliament isn't sitting yet. It won't be sitting till July. The Labor Party's in a negotiation with the Greens regarding superannuation. They clearly want to take all the bartering power of the Greens away from them. So get this thing through, have your 10-day settlement period, and hopefully it's not an issue for Parliament when they sit down in July and they're talking about superannuation. Australia has appalling, you know, parliamentary and governance at present, really bad. And I think young people must be looking at this and going, what is going on here in this country? Are they looking after our future? Or are they trying to maintain power in this country and trying to avoid big debates about where the country's going? I think the way this is played out is appalling. Look, it's good news for Woodside, yeah, and they need some good news because they're being hammered under government policies and bureaucracy and corporate governance issues for the last 2 years. So some good news there for Woodside.
Yeah, I remember Woodside at a share price of around $40. It's now 22. But John, you mentioned superannuation, obviously top of mind for lots of people. You've written extensively about it. I know that you're about to release a new op-ed piece. What are you going to be saying in that opinion piece, John?
Well, the op-ed piece is being published. It'll be published on our website. It's also on First Links if people want to read it. But it really is putting it into context, Paul. I don't think anyone's in dispute that large balances in super need to be reined in, and no one's in dispute that there should be a different tax regime applied. There is no doubt that the unrealised tax has about 0.1% support. An unrealised capital gains tax is appalling. it's hard to find anyone who supports it, apart from people who really haven't thought about it. In terms of what I'm writing, I'm putting it back into historical context. I keep on saying, and I think I said this last week, that the issues today emanated from decisions made 20 years ago by a bygone parliament who was full of conflict. The members of parliament in 2005 were in the main recipients of defined benefits, and they grandfathered it for themselves. They got actuarial calculations which were so wrong, it's embarrassing, wrong by hundreds and hundreds of billions of dollars. So they grandfathered themselves index pensions with all the tax breaks involved in that as a compensation for what I call about the wealthy elite. They said, well, you guys can pile into super as much as you can. And there was like a 2 to 3 year window created by Costello. It wasn't checked fully until about 2016 under the Morrison as Treasurer, where we put pension caps on, transfer caps. But those decisions 20 years ago have created the mess, a lot of the mess we see today, where we've got a defined benefit scheme which is out of control in funding, the taxpayers paying through the nose to support ex-politicians, the judges, ex-high-level public servants, ex-defence personnel, maybe all worthy people, but they're not worthy of getting hundreds and hundreds and hundreds of thousands of dollars of pensions for life. That's where it's disconnected. And we've got a debate here where a lot of critical information is being kept away from the public so they understand the big trade-off that was made 20 years ago, which has landed us in this position where there's a lot of big super funds, way too big. I would say 3 million is not unreasonable. For someone who's been in the workforce for 45 years, it's not unreasonable that they have, through compounding and diligent saving, got 3 million in super. Why is that a problem? Okay. Then we see under this defined benefit scheme, if people look at it, back in 2005, ex-public servants, politician, etc., could retire at 55.
Yeah.
They could retire at 55. And now we're saying to people, you can't get a pension till you're 67. Now, all these issues are not put in front of the public so we get a rational conclusion to a major problem caused by previous treasurers and previous governments, previous parliaments, who have set this generation up for a real problem in trying to fund promises of pensions which should never have been promised at the time, okay? And there's a lot of high-profile people who are getting big pensions who will never tell you publicly what they're getting, okay? Not only are they getting pensions, they're getting big salaries because they got their pension at 55. So there's a lot of issues around this, Paul, and I think our younger viewers in particular should try and get informed about what actually happened 20 years ago when probably a lot of them were young or weren't even born.
Yeah. Let's switch overseas. Trump has been negotiating with the Europeans, threatening big tariffs, then backing off. In fact, people are now talking about the taco trade. Trump always chickens out. He lets out the big escalation and then quickly de-escalates if anyone opposes it. And it looks like people like the Chinese, the Europeans, probably are going to get better deals than they initially expected. Do you think that this tariff nonsense is going to be solidified into the global economy and actually pull back global trade, or is it just a lot of noise?
Well, there's a lot of volatility in global trade, as we explained last week, with this stop-start of tariff and truce periods. We've got a situation now where one day the Trump administration says we're going to whack high tariffs on. 2 days later, they said we've had a phone call, so we've had victory, on the basis of a phone call to call a meeting. So they're claiming victories over very minute issues, okay? There's no solutions in sight. I think we're going to land around a 10% tariff on most goods coming into America. It's effectively a GST. I don't know, the public's going to pay for it, the consuming public. And then they've got to work out in the American budget how they can relieve the American low-income earner on the impost to his cost of living for the tariffs for some tax deduction. And there's a big bill in front of the Congress and Senate. There's a lot of discussion regarding will the judiciary get involved regarding are these things legal, and the tariffs in particular. I think they're heading into a bit of a stall in America, so a lot of noise but not much happening. And time is of the essence in America. The administration's got, had 2 years before the next midterm. Every month that goes by is another month lost. So we've got to get away, or the administration's got to get away from rhetoric and start claiming victories and get victories, And meetings are not victories. They're just meetings, okay? So it does throw up the issue, going back to your question, is it going to affect world trade? I think there's going to be some trade issues in America, compensated for by trade growth everywhere else. Frankly, that's what's happening, and that's what China and America do. You can see they're all running around the world trying to do trade deals in the Middle East and Asia, particularly China now, following America's visits, to try and solidify their trade arrangements. So I think, trade will continue and the world will continue to grow, probably faster outside America than in America.
Yeah, and in the meantime, the actual data coming out of America remains reasonably strong. The share market has recovered very strongly from its April low, and people feel that the Fed has got their back and will carry on dropping interest rates as. So
Look,
the tariffs haven't really been very inflationary, have they?
I think we won't pick up on the inflation numbers for another 2 months. So and because it's stop-start, it's very hard to track. But if a 10% tariff goes through in the second half of this year, there will be an increase in inflation of about 0.5 to 1%. That's what's going to happen if we put that tariff through. So where we sit now, the tossing and turning is making it very hard for the statisticians to work out what's happening in the market. But I'll just throw this one at you, and I've said this to a few of our presentations. You saw the discussion with Apple recently about if they don't bring back manufacturing, there's a 20% tariff or surcharge on their goods. And I just thought to myself, and let's just play the game. We've seen what happened in terms of China's dramatic manufacturing of electronic vehicles and going from nowhere to virtually being the biggest manufacturer, and probably using the expertise of Tesla. So Tesla obviously moved manufacturing into China, and China's run with that and built their own EVs and now are the biggest producer. Let's just think about what could happen if Apple brought home all its manufacturing from China and related countries back to America. You would have a lot of vacant manufacturing factories in America, in China, which used to make iPhones. It's not hard to imagine that those factories would then be turned around and, to coin a name, probably produce Mandarin phones in competition to Apple phones, because they've got all the technology, they've got all the know-how, they've got the manufacturing, and that would happen very quickly if Apple decided to vacate China. They would create a massive competitive problem for themselves if they did that. Now, if you think that's far-fetched, I think the evidence is clear that there's a pretty strong reason why why Apple won't want to vacate the Chinese manufacturing market, because it would open up itself up to a serious trading problem.
Yeah, so often there are unintended consequences of these decisions, which seem good ideas at the time. John, back to Australia. One of our big companies, a hospital and health asset operator, Healthscope, has gone into administration. I mean, this is a company that I think a couple of years ago, Brookfield paid something like $4 billion for. Now it's going into administration. Do you know what's gone wrong there? Is this over leverage and poor management, or is it indicative of problems in the Australian health sector?
Well, when you're providing private healthcare, you are servicing a section of the community who are fairly well off and can pay their insurance premiums. But unfortunately, that's a dwindling percentage of the population because we don't distribute wealth that well in Australia. So having a two-tiered medical health system, private and public, works until it doesn't. And then you get an interesting tender or bidding duel between various private equity. And remember, the industry funds of Australia at one point were part of consortiums bidding for Healthscope, So just remember that. So as this company dwindles into receivership and the equity is written off, billions of dollars of equity, that could have been billions of dollars of money paid for by Australian industry funds. Having said that, if they were prepared to bid billions of dollars of equity for this hospital group, 3 or 4 years ago. Why aren't they at the table now saying, well, how about we buy it for $1 and renegotiate the debt, take some of the debt on our own balance sheet and structure a deal for the benefit of their investors or their members? Because surely they couldn't have got it that far wrong 3 or 4 years ago. And then we've got the Future Fund, Paul. What's the Future Fund doing? These are very strategic health care assets in Australia. There needs to be, a bit like Whyalla steel mills, there needs to be government intervention. There is plenty of capital in Australia to own these hospitals. But someone has to come in and negotiate. I don't want to sound like Trump, but someone needs to do a deal where, okay, the past mistakes are written off. Thank God they're foreign mistakes. We've got hedge funds all over the debt market in Healthscope. So here we go. They're like leeches, buying debt at a discount. The Australian government should have probably said, no, we don't want any foreigners buying the discounted debt of an Australian private hospital group. That would have been a nice thing to do, but they've let it go because it's debt, not equity. But that debt will eventually be turned to equity and we'll have foreign ownership again of our private hospitals. I think it needs a lot more thought, needs a lot more intervention, and governments turning their back on this and saying we don't want to get involved. They should be involved because this is a major service to the Australian community.
There are 37 hospitals, as I understand it.
And a major one on the North Shore of Sydney. These are seriously important assets. So I just leave
Brookfield was unlucky with their timing because they pitched that bid just before COVID, which then impacted on the revenue stream that they expected out of these hospitals.
Yeah, but that was for a couple of years and it's come back flying. I don't know what they've done. They've obviously mismanaged the assets or they've overpaid seriously, or maybe both, probably both.
Well, it's a case of watch this space. John, we'll have to end it there. We're hitting time limits, so thank you as usual, and we'll see you next week.
Thanks.